Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, so today Mena and I would like to talk about some end-of-year financial planning for business owners. So really go through a checklist of items that, we would generally consider when discussing end-of-year planning with clients. Of course, it's not an exhaustive list, and also it's not meant to be a list where, you walk away and just take action. Of course, it probably requires additional conversations with your holistic accountant. I mean, some things are pretty straightforward, but I guess what we want to do is say this is information, of course, as always, not advice. So let's jump into it, Mena.
So the first thing that we typically encourage clients to do with that have trust is obviously their trust distribution resolution. So typically what happens before 30 June, if you've got a trust, you need to prepare a resolution to dictate how you anticipate to distribute your profits for that financial year. So this involves a bit of planning in the sense that you got to sort of determine what your year-to-date income looks like, where's everyone's tax positions are, and then determine what the most tax optimal sort of distribution would look like and stipulate that in the trust distribution. Now, I caution clients to always check their trust deed when it comes to preparing trust distribution resolutions, just because there's different treatments between accounting and tax profit. So just speak to your accountant, make sure they've got a copy of that trust deed that they review before they actually prepare the trust distribution resolution. The next one's around Division 7A loans. Now, this is when a company or trust has advanced money to a company and has resulted in a Division 7A loan because the cash actually hasn't physically been made. Now, if there has been a new loan from the 2024 or 2025 financial year, so last financial year, you got to make sure that you've got a complying Division 7A agreement in place. So it's a pretty simple loan agreement. Most of it are pretty templated. Your accountant should have a copy and be able to, if they haven't already. It's usually done with the year-end compliance. The next one is around superannuation guarantee. So you can get the deduction for the accrued superannuation. The payment actually needs to be physically made before 30th of June. So what we encourage clients to do is that last pay period, ensure that you've actually processed the super for that last fortnight or month or weekly pay, just so that it exits your bank account and you can actually claim it as a tax deduction before 30 June.
The next item that me and I would normally talk about is really whether we want to pay bonuses or directors' fees. I guess this is really paying out to the owners of the business. And it just depends whether you're going to take a dividend or distribution, depends on your income structure. But if you are going to take money out of the business through a wage, as again through a director's fees, just a normal wage or bonuses, that needs to be processed through single touch payroll. So the actual cash has to be paid out before the end of 30 June for you to be able to claim a tax deduction this year. The instant asset write-off, that was probably the only good news in the budget in May, was that the instant asset write-off will become permanent. So I think, it's been around for a while, really since the beginning of COVID. And I think any business that has had some capital expenditure they were considering has probably brought forward most expenditure. But just so you know, if you spend $20,000 on an asset and that asset is installed and used to produce taxable income, as soon as that is the case, you can write it off in one hit. So that's a positive, but there's not too many positives really in the budget. So let's not overplay it. Think about any deductible business expenses that you can prepay before 30 June. So, the most common one, I guess, if you've got debt is prepaying interest. That can be useful, but, you really need to really think through, whether you're getting into a situation where you're then forced to do that almost every year, irrespective of whether you want to. I would just be really thinking about there's two benefits of prepaying expenses. One would be that this year's income or taxable position is expected to be higher than next year. And so, of course, you want to try and bring forward those tax deductions. The other benefit is the timing of paying tax. If I can claim a tax deduction this year, then obviously I pay less tax. Even if it means I'm prepaying next year's expenses and going to pay more tax in the following financial year. I guess it just depends on the amounts involved, but sometimes it's rats and mice. It's not really moving the dial very much. Think about whether you have any unearned revenue. So that's in a situation where a customer or client may pay you, but you haven't delivered the product or service that is required for you to be legally entitled to that revenue. So I guess if you receive prepayments as revenue, you just want to think about how you treat that, and maybe that goes into prepaid revenue so that it's not recognized. You'll just have to speak to your holistic accountant, whether you do your tax return on an accruals or cash basis, and whether that opportunity is available to you.
Now, one of the most sort of undervalued tax planning matters is around stock takes and bad debts and obsolete assets. Now, a lot of us in business, sort of, especially in sort of manufacturing businesses or businesses that sort of carry a lot of stock, don't necessarily conduct fully pledged stock take. Now, that can work against you. If you have less stock than what you actually think, that can result in inflated profits and paying tax on money that you actually haven't earned. So we always encourage clients to do a really thorough stock take at 30 June, just so that it really reflects how your business has actually tracked. Similarly, with bad debts and obsolete assets, if you're just carrying these forward and not reviewing your asset schedule regularly, make sure that you do so that you can write off any assets in that financial year if they no longer exist. The next thing to consider is PAYG installment variations. Now, if your business profit is materially lower than what the ATO's assumed figures, which is typically based on last year's profits, then you can vary the June installment downwards. Now, just be careful with this. If you go too aggressive with the PAYG variation, the ATO can actually charge you shortfall interest charges for monies that they would have otherwise received earlier. Now, the ATO are becoming a bit more aggressive with these kind of matters, so just be wary. Conversely, if your business profits are actually up and you want to actually pay a dividend out of the company, just so that you got enough franking credits, it might be wise to actually vary the installment upwards. That will be your March quarter installment upwards, just so that you got enough franking credits going forward. Now, for FBT, just be wary that the FBT year actually ends at 31 March 2026 and commences 1st of April. So just make sure that you've got all your FBT returns lodged in time and that any sort of recipient contributions are also calculated before 30 June. If you're a business that has personal services income or personal service exertion, PSI income, just make sure that you're appropriately planning for that, whether it includes sort of bringing in anyone that might have assisted you with sort of administration, prepaying any expenses, consider any superannuation contributions as well, just to reduce your PSI exposure.
That's right, Mina. And just on the PSI discussion, quite often when we do some tax planning at the beginning of each year, we think about the components of business income. So if what you expected at the beginning of this financial year actually turned out to be different, you might want to kind of re-engage in that conversation. So if you think you've got more business income than PSI or vice versa, it's always good to sort of look back at it. Next one is to think about losses. So if you have multiple trading entities, they all in profit or some in losses, you don't want a situation where you've got one entity that's making a loss, another one that's making a massive profit. You'll end up paying more tax and carrying the loss forward. So just think from a group perspective in terms of distributions, intercompany loan charges, these sorts of things. It's always good to try and smooth it out across the group. Payday super is something that's, as of 1 July, businesses now have to process super within 7 days of actually paying salaries. It's much easier now with, a single touch payroll and using Xero or MYOB, whatever sort of software you use, or whether it's a separate payroll software. But very simple these days. And I would just get into the habit, even from now, paying super whenever you pay payroll, just to make sure that process works and you iron out any kinks so that you're ready to go by 1 July. The next one is single touch payroll, probably not end of financial year. It's a post financial year requirement, but you need to finalize your single touch payroll by the 14th of July. So that used to be the old PAYG summaries that you'd have to send out to employees that were employees during that financial year. Now, again, it's all automated. So it's really about going through a process of doing a reconciliation, making sure all the data is correct, and then completing that single touch payroll. Again, that's something that you can liaise with your holistic accountant by doing, but it needs to be done by 14 July. Okay, apart from business considerations, there might be some additional considerations for you personally. So the first one is concessional contributions. So they're the contributions that you claim a personal tax deduction for. Again, you might want to think about whether you want that deduction to sit inside an entity or in your individual name. That's something that your structure will really dictate. If it needs to be inside an entity, then it needs to be paid through single touch payroll in that entity, and it needs to be done before 30 June. If it's personal contributions, so you're going to claim a personal tax deduction, the contributions have to be made and received and credited to your account by 30 June. And look, industry super funds and different super funds will have different cutoff times. But look, I would suggest that you make any super contributions before the middle of June, just to give yourself and give the super funds plenty of time so that you're able to claim a tax deduction for that. Remember, the cap this year is 30,000. So if you've drawn a salary from your entity, from your business, you'll need to net any superannuation guarantee contributions that your business has made on your behalf. Or if you pay premiums for insurance policies that are owned by super, a lot of self-employed people can have that. So again, that can be counted towards your contribution cap as well. So net of those amounts, up to $30,000 a year you can put into super. Once you've done that, you'll need to complete what's called a notice of intent to claim a tax deduction form. They were up all night thinking of the name of that form. Anyway, it's something that you've got to do otherwise, because once you make a super contribution, the super fund will typically treat it by default as a non-concessional contribution. So until you tell them, no, actually, this is a personal contribution and I'm going to claim a tax deduction for it, they won't reallocate it. And that form needs to be lodged before you lodge your tax return so that that data comes through into the tax return.
And just on non-concessional contributions, if your super balance is actually under $2 million as at 30 June 2025, you've got certain non-concessional contribution opportunities up to the value of $360,000. Now, the thresholds and caps increase from 1 July, so it might, in some cases, depending on how much you want to get into super, it might be better for you to delay your contributions until next financial year, or put part this year and then use the bring forward arrangement next year. So this is typically helpful if you're sort of nearing retirement or trying to boost your superannuation balance, or you might have had a liquidity event during the year and you wanted to sort of boost your retirement savings. That's a good sort of method to do so. Now, just on the conversation of carry forward contributions, just to go to Stuart's point around concessional contributions, there's also carry forward contributions available for concessional contributions. So contributions you can actually claim a tax deduction for. So if your superannuation balance is under $500,000, you've got the ability to use up to 5 years worth of contribution caps that you haven't utilized previously. Now, this is really good especially if you're sort of nearing 30 June and you're really close to that $500,000 cap. We will typically recommend our clients to utilize all 5 years, because that will really be the last year that you can actually use the carry forward contributions. Once you breach that $500,000 cap, you can no longer use the carry forwards. So it's a really good planning opportunity to consider going forward. Might I also add that if you're not nearing that contribution, that 2021 contribution cap's the last year that you can use. So I would recommend at a minimum try to utilize that cap before 30 June. Now, when it comes to other sort of types of superannuation contributions, consider spousal contributions. So if you contribute for your super for your spouse and they've earned under $37,000, then you can get a $540 tax offset in your personal return. Similarly, the government also does a government co-contribution up to $500 where the total income is less than $47,488. So it's really helpful if you sort of want to boost your superannuation balance, but your income isn't high, to voluntarily contribute into super, and the government can contribute a further $500. Now, just on CGT caps, when it comes to business sales, if you qualify for the small business CGT concessions, it might be a good sort of opportunity to consider the retirement exemption and put money into super. There is a cap for that contribution of $500,000, but you could potentially split that between spouses too.
There's some additional considerations, end of financial year considerations, if you have a self-managed super fund also. So the first one is if you're in pension phase, just making sure your minimum pension withdrawals. So they're age-based limits, which starts at 4% between age 60 and 65, which means that you've got to draw at least 4% of your balance. Between 65 and 75, it's 5%. So, and your balance as at 1 July 2025. So always good to make sure that you've done that to ensure that you comply. Next one is Division 296, which is the new tax for balances greater than 3 million. get an additional tax of 15%, and balances greater than 10 million, additional tax of 30%. A few planning considerations here, really working out what to do if you do have a high super balance. Now, this is not the self-managed super fund as a whole. This is individually. And I think the same planning opportunity exists even if you don't have a self-managed super fund as well. The opportunity that's available to self-managed super funds is resetting cost base. So how they calculate the tax that relates to 296 is different to your traditional calculation. And essentially what they allow you to do is draw a line in the sand as at 30 June 26 and reset the cost base of assets at that time only for Division 296 purposes. Now, most people might think, okay, well, I'm under $3 million, so I don't need to worry about that. But the point is that if you will be over $3 million one day, then resetting the cost base today makes sense for everyone, almost regardless of their balance. So something that you need to speak to your super administrator, so whoever looks after your self-managed super fund about. You don't have to do that before 30 June. You just have to do that before you lodge your 26 tax return for the self-managed super fund. So look, that could be many months away now. So you've got plenty of time up your sleeve. The next one is about redoing valuations. It's up to the trustee to make sure that the valuations on the balance sheet in the self-managed super fund reflect fair market value. So have a think about whether any of those assets need to be revalued, and most importantly, they reflect fair market value. And finally, have a think about the balances in your self-managed super fund, how even or uneven they might be between spouses or members, and think about whether you want to do any contribution splitting, recontribution strategies, contribution reserving. Look, some of this sort of stuff gets a little bit technical, but the closer you are to retirement or converting into pension phase, the more you want to start thinking about these things, and the more uneven member balances are within a self-managed super fund, the more potential planning opportunities there are as well.
Now, when it comes to your personal tax returns, just consider prepaying any deductible expenses similar to how we sort of mentioned it in a business sort of checklist items. So things such as like income protection insurances, fixed interest loans that you can prepay, bring forward any expenses that you can for the rental property. Just be wary that some of them might be capital in nature. Also consider managing your capital gains and losses. If you've realized some large gains in the year and you're sitting on some sort of losers in terms of investments, it might be worth sort of getting rid of those and to offset against some capital gains. And then also around donations, if you want to regularly contribute to sort of deductible gift recipients, consider sort of prepaying those before 30 June as well, so you can get the upfront deduction.
One planning opportunity we've been looking at for clients recently, just off the back of Mena's comments in terms of looking at winners or losers, but CSL in terms of the listed stock on the Australian Stock Exchange has had a horrible year, really horrible year. So sometimes that's an opportunity where we've got a client that has crystallized capital gains in the 26 year and they hold CSL stock. It could be, you're either going to make a decision to hang in there and ride it out. So I'm not suggesting CSL won't recover, but it could be an opportunity to say, well, I was planning to reduce my exposure anyway, and now might be a good tax effective way of minimizing any CGT in doing so. So just one example of how you can start thinking about these things to create better outcomes. It also, end of financial year planning can also be a good opportunity to just run the rule over, your superannuation fund, how well it's performing, investment properties, any insurances that you might hold, structure, and then start thinking about planning for the 27 financial year. So if you discover things that aren't perfectly optimized now and it's too late to, fix 26, have a think about what you might want to do in 27 and get that year right. Okay, we'll leave it there. We'll put a link in the show notes to the 8-page checklist. There's plenty of items on there. We haven't discussed all of them, but hopefully that's helpful for listeners to sort of work their way through. And like I said at the beginning, it's not advice here. They're just items to create really conversations or thought processes. So please don't act on this information. Make sure that you run it past your accountant. That's it for today. Until next week. Bye for now.